In the last screencast, we looked at rebalancing from the perspective of a grocery shopper. Now let's take a look using some real equities. Here we have two ticker symbols, one for a large cap domestic fund and another for a intermediate treasury fund. They're both ETFs provided by Schwab. Here's the live quote. Our desired allocation, 70-30 split. Current allocation based on the shares versus the quote. And here's our value in dollar amount. And here's our total value. Now let's take a look at how we can create this using Google Spreadsheets with live updates. I want to first start with the total field and just explain that this is an addition of the cells G2 and G3, which is where our value for each stock is eventually going to live. Keep that in mind with the total because that'll increment automatically for us. We're going to go with two symbols here. We're going to do SCHV and SCHP. And this is large cap equity, and this is a TIPS fund. Doesn't really matter. It's just a stock and bond allocation. We're going to do a 70-30 split just like the other one. These are all the fields that we need to fill in right here. And we're going to do 40-20 right there. Now, we can start by getting the quote here using a great Google Finance service that's really easy. And if we just throw in the cell number, A2, then we're going to get the quote for that exact stock. If we drag this down, we're going to get it for A3 as well. That gives us a live quote that'll update throughout the day. And then in this case, we can actually calculate value now because we have the simple calculation of our shares, which would be F2 in this case, times B2. So it's a share times our quote. Makes sense, right? That's the current market value. And we're going to drag that down. And you can see that both the numbers increment here. This is a standard Excel as well as Google Finance feature. So we've now got our values. We'll do those in a little bit to format them up. And then our current allocation is going to be based on our total because, of course, the allocation is the amount of money we have versus the total amount of money in our portfolio. So it's a really simple calculation where we take our value, which is also a calculated field, so G2, and then we're going to divide that by B5. And right now, that's using a number format for currency. So let's bring this down. Unfortunately, it's going to increment B5 to B6, and we want that to be the same number. So let's do that. Let's format these guys all as percentages, which is actually what we want. Okay, that looks a little better. These guys should be money. Go with currency there. And everything else looks pretty good. So now, as you can see, we can up our shares. We can say, okay, let's buy a little bit more of SCHV, and slowly our allocation is going to get back into sync. And this is exactly what you would do as a buyer of this equity. Likewise, if you maybe sold off a few shares of this, you're going to get your allocation back into sync. Now, as these quotes are changing in value, that's, of course, also going to change the way your allocation works. And given a couple months, you're probably going to have an allocation which is slightly out of whack, which, of course, you then correct with more buying and selling.